Welcome to this episode of Dividend Discussion. In this series, I really want to give every dividend investor a chance to tell their story. We're going to get to hear things like when and how they got started, mistakes made, lessons learned, and much, much more. My ultimate hope for this series is for the guest, you the viewer, and even myself to be able to take something away from this conversation to make us all better dividend investors. No matter if you're retired and living off of dividends or just got started yesterday, there's always something to share and even more to learn. So if you're interested in being on your very own episode, reach out to me via email at dividendobsession@gmail.com and I'll be in touch. But without further delay, let's get to the interview. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. My name is Troy and today I have the pleasure of speaking with Tom, the savings captain from Twitter or X. Tom, go ahead and tell the people a little bit about yourself.
Hey, good morning, Troy. This is Tom, the savings captain on X and also host of the Money Happy Hour podcast. Hey, just briefly, I'm 55 years old, young, and I've been investing since 1991 and spent 32 years in financial services as my trade, as my career. So I'm an investment broker, CFP by trade, and 9 to 5 free for 372 days now, but hey, who's counting?
Yeah. I mean, not something you need to take care or track or anything. So that's pretty cool. Hey, we all aspire to be there, and you're not, you're not 80 years old and retired. So you did something right. So that's pretty cool.
Yeah.
Okay. So you touched on it. You said 1991 is when you began investing. So that's right? Okay.
Yeah.
Okay. So in 1991, you began investing. Did you start with dividend investing?
It's a great question. I call myself the accidental dividend investor.
Okay.
So what I mean by that, I didn't buy my first dividend stock. I would have to fast forward to at least about 2001 before I bought my first dividend stock. I spent the entire 90s avoiding dividend stocks. Even the early 2000s, the only reason I bought a dividend stock was I did probably some sort of Peter Lynch thing, buy what you know. And I bought stock in Coca-Cola for me. And right around then, my daughter was born. I bought her Coca-Cola and would add $50, $100 to it every month. And the reason I bought Coca-Cola, buy what you know, I was drinking 12 Diet Cokes a day. I said, hey, I might as well invest in something I'm doing. And guess what? Coca-Cola, it would grow, but it would also pay a quarterly dividend. And they started stacking up. So that's accidentally how I started dividend investing. But most of it served me pretty well because back in the mid and late 90s, we were in a very similar stock market that we're in right now. Very growth oriented. Semis were doing well. Biotechs were doing well. So I caught the benefit, I think, of a lot of growth when I was younger. And, now I'm 55. I'd say 80% of my stocks pay dividends. So that's why I'm the accidental dividend investor.
Yeah. Well, I think you're going to be my 30th or 31st or 29th, somewhere around there interview. And I would say like 80% at least of the interviews I've done, people stumble across dividend investing. Most people just start with like the get rich quick kind of stuff. Then you end up it's always, you end up owning this stock that you don't know pays a dividend. You get a dividend and you're just like, then everybody goes down the rabbit hole. What's a dividend? Why did I get this money? What other stocks pay this? Typically that's followed by like higher yield chasing. You're like, oh, I got paid by this. Let me see if this one pays a 10% yield. That one only pays a 4%. So that one must be better kind of thing. So when you said from 91 to 2001, before you bought Coca-Cola, that you avoided dividend stocks, was there a reason behind that?
One of the early reasons. So I was a broker, as I'd mentioned, I'd say in the early 90s. I mean, Troy, I was probably 23, 24 years old and handling people's, retirement portfolios. Yeah. So I was dealing with 60, 70, 80 years old back in 1991. And I remember reviewing their portfolios, and the holdings I saw in there, they looked so boring compared to the biotech stocks and the semis. I wanted nothing to do with it personally. So I had to manage their money, like a 3% dividend yield on Bristol Myers in 1992. I'm like, shoot, I could get that before the end of the close in a biotech stock.
Yeah.
What would I do it? So it created this almost alienation effect for me. But yeah, I called it, I invested my age. It amazes me today the number of 20-year-olds I see that are not just investing in dividend stocks, but like that's the core of their investment
Mhm.
strategy. Dividend investing. That's probably the biggest thing I've seen change in 30 years or so.
Well, so I actually speak a little bit more on that. So like the to me there's a big difference between people that are, my age or younger that start into dividend investing young, because that's when you do get to see
Yeah.
the compounding and the snowball and stuff really take place, when you got 30, 40, 50, 60 years to let a snowball roll versus, 20 years or whatever. But like there's also the trap of people being 20 years old and getting into something like the yield max funds where they're getting really big
Yeah.
dividends, but they're not understanding that there's so much more runway. Like they don't need the money now, but everybody's so obsessed with getting a 60% yield today, even though they don't need the money. You know what I mean?
Yes, Troy, I'm glad you brought that up. That is the biggest, probably, mistake, in my opinion, cardinal sin I see people in their 20s making. It really just comes down to chasing yield,
Mm-hmm.
right? So it might be one of two things: some of the yield max holdings, right? The other thing I see is companies that are so mature that there's really no growth in
Mm-hmm.
them. They might be paying a 5, 6, 7% yield. In my opinion, if that's the focus of a portfolio in your 20s, you're really stifling growth
Mm-hmm.
that you probably need. You're probably better off. It's the same equation, right? Compounding. Well, you can compound the income, you can compound growth, you can compound both.
Mm-hmm.
But some think going too heavy too early. It's funny. I have a post coming out tomorrow or sometime in the next couple days. If you're in your 20s, please don't buy don't buy REITs.
Yeah.
There's gonna be time for that. Well, maybe buy a REIT or two, but sometimes I see like a 24-year-old, they 80% of their portfolio are in things like REITs. I'm like, dude, man, you're young, you're in your 20s, sow your oats a little bit more
Yeah.
with your portfolio. Get a little bit of growth because you're not going to be able to. You're going to come out ahead. So you build. I think you build that capital. You build that nest egg a little bit, and now you have a high six-figure income portfolio, a seven income portfolio, and maybe you're in your 30s, early 40s. Compound that out another
Mm-hmm.
20 or 30 years. Powerful when it comes down to dividend investing or growth investing. Yeah.
Yeah, yeah, I see it all the time. Like, one of the apps I use is called Div Tracker, and it does like a really cool like pie chart at the top, and it talks about like here's your holdings, here's the percent that they're all allocated, and it puts it in like a really nice, I don't know, 2-inch thing that you can see, and people will screenshot that and share it all the time. And I'll see, hey, I'm 24, just got into dividend investing, which obviously good job for starting, but then like 63% of their portfolios in realty income, another 22% in AT&T. Then they got some MPW and stuff like that. And I'm just like, what? Like, I can see
Yeah.
what you're doing. Like, yeah, it looks great well, in your head, it looks great today because you might be making X number of dollars in dividends, but you don't need the dividends today. And then, so I don't know if
Right.
you're familiar with this, but there's a strategy. I want to do a video on it, but I've just had other things to get done. There's a strategy out there, commonly referred to as the dividend avalanche method. Have you heard of that?
I sure have.
I don't think it works, but everybody wants to try it. They want to take whatever, say they want to take 10K, put it into AT&T and get your 6 or whatever percent yield. Then they want to take the dividends from AT&T and then they want to put it in VOO or SCHD or something like that. And I'm just like, why wouldn't you just put the 10K in SCHD or VOO from the get-go?
Right. I totally agree with that. When I hear methods like that, look, there's worse things you can do.
Yeah.
Buy a lottery to keep your money in a savings account,
Yeah.
So I would say, but when I hear things like that, it's like trying to circumvent the process.
Mm-hmm.
And I think getting it, just it's a simple game. It's the rule of 72. Just try to compound at 8 to 10%, the market average over an extended period of time. That's all you're trying to do. Grow your money, then turn that into something income producing quite easily. So when I hear that, it's kind of, to me, it feels like you're short circuit. I get why people do it, but they're short circuiting the system, in my opinion.
Yeah. Yeah. And it's not even like, so one of the, and you might actually be able to use this video that I made in the post that you're talking about, or at least like help argue it. So one of my best, like, I feel like one of my best works so far was a video I made called The Dangers of Investing in Yield Too Soon. So what I did is I broke down, I think it was like three very popular higher yielding dividend stocks. And it shows you like what you're going to make today in dividends, and with the capital appreciation, the dividend growth rate, and the yield, what you would make in 20 or 30 years off of those same stocks and dividends. And then I did some really lower, um, more popular yield stock. So very popular lower yielding stocks. And I did the same thing based on the dividend growth rate, the capital appreciation, and the yield, what that would give you today and what that would give you in 20 or 30 years. Now, obviously, it's hard to predict 20, 30 years, like fundamentals and stuff change. But what the video premise was is, in if you don't need the money for 20 or 30 years, not only would the AT&Ts and the 3Ms and stuff like that of the world, sometimes their dividends are projected to go down because of like the overall growth, but you got more money in year 1, but you don't need it till year 20. And then you look
Yeah.
at the Costco's or something, I don't remember what the stocks I used, but you look at those, and because of the metrics that they present, in year 20, when you actually need the money, you're making more dividends that you need at the time. So like I that video is one of my favorite videos I've done, just because it shows the numbers behind it and shows you that, like, hey, like, don't focus on today for tomorrow results. Like, you have to focus on tomorrow's results today by planning for that. Like, you have to set yourself up for that.
No, that's powerful when you look at it that way, not chasing yield. Hey Troy, can I go back and just tell a real quick
Yeah, yeah,
story
absolutely.
that this kind of relates to, like, why didn't I invest in dividends like in my 20s? And I remember this client that would come into the office. His name was Mr. Arnold. Mr. Arnold happened to be, he was in his 70s. Mr. Arnold was the client of another broker in the office. And think about it, back in the 90s, everything was still paper driven. I mean, you had to research your stuff in like Morningstar books. Well, Mr. Arnold would come in every week or so and meet with one of my friends who was a broker in the office. Mr. Arnold had a couple $1 million in his portfolio. And guess what Mr. Arnold invested in?
Boring dividend stocks.
Boring dividend stocks, mostly REITs. From what I remember, most REITs were paying, a good dividend yield back in the 90s. It was probably 7 or 9%. That's about where the market was. And Troy, this guy would come in, Mr. Arnold, and I'm thinking, here he is. I'm in my 20s. Here he is in his 70s. And every week he's coming in with these books and basically breaking this other broker's chops. Should I buy 1,000 shares of this, 1,000 shares of that? He's got a couple $1 million. To me, that's all the money in the world. I think I had maybe $2,000 in my savings account at the time. And I'm thinking, wow, is that what dividend investing really is? That does not look fun. I mean, sure, he needed the income at the time, but he was such a yield hawk, yield chaser. He never looked happy. It certainly didn't look fun. And I'm like, I'm going to build a nest egg like that. And that's the finish line. Why would I want to train for that marathon?
Yeah.
It didn't look good. You jogged my memory. That was one of the hindrances that kept me from dividend investing when I was thinking of people like Mr. Arnold back at that time.
Yeah. Well, I mean, and it's one of those things, like, obviously, he can't go back and change time, but I wonder if he would have had, what is widely considered to be the wiser strategy of like focusing on sustainable dividend yields with high company growth. So both, so total return, which people don't seem to understand is a thing. If he would have focused on that and then transitioned into something, because that's my goal, is like my portfolio yields like 2%. I have, companies that are compounding their growth rate at least 10 or 11%. So they're just going to grow it. I'm going to let them do their thing. If I get to the point, because I want to retire at 50. So if I get to the point at 50 that my yield on cost isn't high enough to support, I can take all the money I put in, all the money that they grew, and I can transition that portfolio into something that does give me a 5, 6, 7% yield, whatever I need to get there.
Exactly.
Yeah.
That's it. I suspect Mr. Arnold, he probably built his portfolio through through personal savings,
Mm-hmm.
being frugal, and also like bank deposit stuff.
Mm-hmm.
It struck me as that. I don't think he was like buying the nifty 50 stocks back in the 1960s or something.
Yeah.
Now I got $2 million. I'm retired. How do I supplement my income? I think he became probably an accidental 70-year-old dividend investor too. But Troy, it did not look fun. And um, when you start talking about average yield of a portfolio, so one of the things I started doing, I've had I've had a lot of people ask me questions. Hey, Tom, what do you invest in? How much do you have? I keep my personal portfolios private. It is a seven-figure, obviously, net worth. Most of it, I do share the names that I own. But in order to give a little bit more transparency, this is kind of funny. About 2 months ago now, I started a portfolio for my producer, Radish, the hardest working dog in podcasting. I opened up a $400 account, of which I put $25 in it. And it's almost like an ETF that tracks my portfolio. It's virtually the same holdings. And I buy it 70% ETFs, the other 30% go in stocks. None of them are what I would say yield chasing things. You made me think of it because I think the average yield on the portfolio is about, I'm doing an update episode next week. I think it's about 2.6%. Anchor it with ETFs still, and that's exactly what I do in my personal portfolio. I'm 80% ETF, 20% individual stocks, of which I own 12, maybe 13 names. And thanks to Meta paying a dividend, I have all my stocks except maybe 3 pay me a dividend.
Yeah. Yeah, that's I don't know. So I was just having a conversation with one of the chat groups on Facebook. I don't know. Now it costs, $1 million or something to come out with an ETF. So I unfortunately don't have the funding for that. But I don't know why there isn't all of the fun. So just simple stuff because ETFs can get as simple or as complicated as you want them to. I don't know why there isn't an ETF that tracks the major indexes. So your S&P, your NASDAQ, your Dow Jones, whatever kind of stuff like that, your Russells. I don't know why there isn't an ETF that tracks those that doesn't pay out in March, June, September, and December. Because like so I was thinking for like my YouTube channel, like it would be, I know that it's very hard to outperform the market. Since I have the YouTube channel, I own 11 stocks on my own. I just this year I started an active versus dormant strategy. So if a stock stops meeting my criteria, I no longer sell it because at one point I bought it for a reason. And I know in doing these interviews, some of the biggest mistakes that I've had is people buying good companies and selling them when they lose a little bit of conviction. So like 2 of my companies that no longer meet one piece of my criteria, which I consider to be my biggest piece of criteria, is ExxonMobil and Starbucks. I'm not going to get rid of either one of those because I still believe both of them are quality companies. And they still meet some of my other metrics, just not the one I value the most, which is outperformance of the S&P 500 over the past 10 years. So I am keeping those positions, and until they start beating that metric again, I'm not going to add to those positions. So I'm just keeping them there. All that to say, like I have all those positions. That's what I track on the channel and stuff like that. So it's really transparent and stuff like that. The issue is it's a lot of work just for the channel. I got to keep all this stuff. And there's a chance I do and a chance I don't outperform the market. And it's not hard to outperform the market a year here or there. What's hard is outperforming the market consistently over long periods of time. So I was like, it would be really cool if there was a fund that either a fund that paid the S&P that followed the S&P 500 that paid out in 1, 4, 7, 10. And to what would that be? 2, 5, 8, and 11, in addition to the 3, 6, 9, 12. But even if there was an S&P 500 tracking fund that paid out monthly, because what I don't want to do on the channel is I don't want to say, hey, it's January. Here's my recap. I bought 3.6 shares of VOO, and I don't get any dividends this month. So come back next month, and I won't get any dividends that month either. Like that's really boring to track. With that being said, I don't want to sacrifice everything. So my Roth IRA is only ETFs. I have ETFs and Tesla in there. So that's your VNO, your VOO, your QQQM, your the what V I forget what the name of the Vanguard real estate one is. It's V something something. I forget what it is. But that's my real estate because I don't feel like owning Vici or Realty Income or whichever one everybody else thinks is the greatest. So I just own the ETF for it.
Right.
So yeah, it's just one of those things. It was just a thought I've had recently. I'm like, man, what if there was like a monthly paying S&P tracking ETF? I'm like, that would be really cool. Or even like one that paid out in like the January months or the February months or whatever. Instead of just getting every ETF in that Roth IRA pays out in March, June, September, and December. I'm like, man, that stinks. Like I don't get anything, no fun the other months.
Yeah. You bring up an interesting topic. You made me think of another thing. So the other odd thing, especially for a person that's, when I see it young, like 20s or 30s, like whatever it is, you don't need the dividend income now to live off of. People build a portfolio on the month the dividend is paid.
Yep.
And I'm thinking, why would a person do that? You don't need the income now. Aren't you just building? Aren't you buying the fundamentals of the company first?
Yep.
Then it pays a dividend. Oh, and then it happens to pay in a certain cycle. It's not like you're 62 years old and supplementing living expenses. That do you have? I have yet to get a really good answer when I've asked a person either on X or a guest of like, if you don't need it now, why are you building this monthly level income stream? I don't understand it, but I understand personal finances personal.
Yeah. I think the answer to that would be, and like I don't, so for my personal portfolio, the one that I do track on the channel is I don't, I have one payer in January. So like you said, I just bought good companies and whenever they paid kind of thing. So the only payer I have in January is Illinois Tool Works. It's a Dividend King. Really good growth rates, outperforms the S&P, all kinds of stuff. So I like that one. And then I have, so like I said, I have 11 holdings in that portfolio. I think 5 of them pay out in February, May, the rest of the months, and then the remaining pay out in March, June. So I think it's psychological, so much so that I've done technically 3 different now not me, I haven't done these, but I've created videos for 3 different portfolios called the Getting Paid Weekly, just because I think that's one of the drawback, like quote unquote drawbacks to gearing in new investors is one, you have to figure a lot of people are chasing the yield. Why? Because they get that adrenaline rush of getting the money today kind of thing. And then the other thing they chase is the monthly payer, which is how people fall into REITs, because a lot of REITs pay monthly. So REITs have higher yield and they pay monthly. So that checks all the boxes for a new investor that's like, hey, I want that dopamine monthly. Like every 14th of the month, I need something.
Yes.
So what I did is I think there's 2 episodes out. I don't know. I think there might be 3 episodes out by the time this interview comes out. It's called the Anyone Can Invest portfolio. And the idea behind it is addressing the major thing that I hear all the time of like, I don't have enough money to invest. Like I can't start investing. Investing's not for me. Investing's for the rich. I'm like, investing's not for the rich. Investing causes you to get rich. That's what happens. Like the discipline and time is what gets you there. So the idea behind that is I put $60 every other week, so per paycheck, into this portfolio. I bought 12 quarterly paying stocks. And how I built the portfolio is the combination of those 12 stocks will get you paid every week. And that addresses the one, hey, I can't invest. I don't know how to invest, all kinds of stuff like that. And I don't have the money to invest. But it also addresses that thing where people will chase yield and they'll chase frequency of payments with high quality companies that just so happen because, magic, they all happen to get you paid weekly, which is nice because instead of having to wait, 3, 4, 5, 6 weeks in between a dividend payment, you're going to get something. No matter how big or small it is, you're going to get something every week. And I feel like that keeps people motivated.
That's brilliant. That really does reinforce, because I think you hit the nail on the head. It's all psychology.
Yeah.
It keeps them back for more, right? Hey, I got paid something. Yeah, I bought a lottery ticket. I won something. Yeah, I got something. Yeah.
Yeah. I mean, you got to think of it like, so casinos, I mean, a lot of them aren't publicly traded. Like, I know Vici is based in Vegas and they own the casinos, but they are not it's one of those, they technically, I don't even think own the casinos. I think they own the buildings that the casinos are in kind of thing. So the casinos aren't publicly traded, but what do? When you go to the casino, you might bet, do a minimum bet, and then you win 6 cents. You're like, oh my gosh, I hit, like, the lights went off. I did something cool. And that's the same kind of dopamine that you get when you get your dividends coming in. Like, no matter if it's my very first dividend was SiriusXM, they paid me a penny. And that got the whole thing started. And it was just like, hey, why did Sirius? I got an alert on my phone from Robinhood. It said, hey, SiriusXM paid you a penny in dividends. Like, what are dividends? Why did I get a penny from them? Do I owe this to somebody? Like, do I need, like, what goes on here? So that's really what I tried to address with that portfolio, is just like, okay, if you're going to chase the frequency of your payment, allow me to create something that will let you do so with quality companies, and you can get paid weekly to keep your little motivation going. Because when you first do, and it's one of the questions I ask in here, is like, when you first do get started in dividend investing, you can, so you're, to me, you fall into two camps. You can either get really excited over just making any amount of money and passive income that you didn't work for, like I did, or you can get started, you accidentally get into dividends, you tell somebody about it, you're like, hey, I just made 5 cents from Pepsi. They're like, cool, let me know in 26 years when that turns into 7 cents or whatever. Like, that's what they do. It's like those two camps of investing, or when you tell somebody about dividend investing. So I just know that from going to the gym. One of my buddies is like he's a hard assets kind of guy. Like, he likes guns and gold bars and stuff like that.
Yeah.
I always joke with, he always jokes with me, if I find like a dime on the ground at the gym, I pick it up, put it in my gym bag, and I invest them at the end of the year. And he's like, oh yeah, if you invest that in 46 years, it'll be worth 13 cents. I'm like, yeah, okay. But like, I'm like, let me know when you have to go to Costco, one of the stocks I own, and you're going to pay in fur pelts. So I was like, let me know. We'll see which one happens first. So it's a little friendly banter back and forth. But yeah, it's really the psychology. I want to do a video on that too, where it's just talking about like ways that I've worked around the emotions of the stock market, like whether the market's up or down, like looking at your cost basis when you buy stocks and your cost basis goes up, like different ways to work around that kind of stuff. Because that's, I don't know what percentage I would put on that, but like that is such a huge part of being an investor, and not even a dividend investor specifically, but an investor in general. Is like, what do they say, that most of the best performing portfolios over the course of a long period of time belong to dead people because they don't touch them.
Yep.
Yeah. So like,
Exactly.
yeah, I don't know. So I think the emotions are, I don't know what percentage I'd put on it, but it's just such a huge part of the whole experience.
Yeah, the psychology is important. It's funny. You made me think. I'm not sure if you're aware of this. SoFi,
Mm-hmm.
they have an ETF. Have you heard of the weekly WKLY? It's
I've
a
heard of that
weekly
a
dividend
while ago, and
thing.
I look at it takes me 4 seconds to look at it. And I'm like, why are people investing in this? But that's exactly why, exactly what you're getting to.
That's exactly why. And you look at the yield, it's something like 50 basis points lower than SCHD. Oh, and guess what? The expense ratio is about 50 basis points higher than SCHD, but it's exactly that. It's like, oh, yeah, I want that weekly dividend. I want that weekly dividend.
Yeah,
That's what it comes down to.
not to mention the expense ratio is probably higher because it's more actively managed.
It is, yeah, exactly. It's the 50. Basically, you're taking a 50 basis point haircut in yield and paying 50 basis points more in expense ratios. That's what it comes out to. Just for that thrill of the weekly dividend.
Yeah.
Yeah,
Yeah,
that's
I remember
that
hearing
hits
about
now.
that when people were talking about monthly. They were like, "Wait, it gets better. This one pays out weekly." I'm like, "What's that like in 5 years?" Because Robinhood's always like, the as much as like crap as Robinhood gets, they're always like the pioneer for like new things in the investing market. So like you have to appreciate them for that, and they already have certain stocks that they allow you to trade 24/7. That's going
Right.
to be a thing in the not too distant future, because crypto's open all day, which is another thing that people enjoy. I can wake up at 3 o'clock when I get done going to the bathroom and I can buy some Bitcoin or whatever. Like, I don't do that, but people do. And it'll be the same with the US stock market now that like everything's done online versus like actually having to call up somebody and say, hey, I want to buy 10 shares of this and here's your fee and all kinds of stuff like that. Robinhood does all that stuff. And I just think it's going to be, not too long after that when you're some quote unquote genius is going to come out with a daily paying dividend fund, and people are going to be jumping all over that. Even though the chart's going to be red and down to the right, you're going to be like, oh, I want to get that daily dividend. I'm like, what are you doing?
Yeah, exactly. That's exactly. You made me think of another thing. Averaging up in a stock, it's so unnatural.
Mm-hmm.
And you Costco a couple times. I have to go back and check my records. I do not think I've ever bought Costco at a lower price I think I've always, what I'm saying is, I think I've always
Yep.
averaged up on this, you know, and it's, people don't consider it a dividend stock, but they're starting to add up. Just got my second special dividend payment since I've been owning it. I'm telling you, to me, that's what dividend investing is.
Yep.
That's what it's all about.
Yep, and that's one of the things I want to talk about, like the psychology of it. One of the things I haven't done this, but I thought it would be interesting. I actually think I brought this up like an interview or two ago. One of the things that would be cool to do is when you buy Costco and like to take the psychology out of it, because I'm the same way. I bought Costco back in like I don't know May or June at like $4.94. And now every
Yeah.
time I buy it, because it's so much, I'm only putting a couple dollars in because I buy every day, just to like see
Oh,
little. Because I get in my own head, and like again, this is one of the things I realized with psychology. I was like, okay, cool. I want to. Here's the money I put in at the beginning of the month that I'm going to invest for the following month. Cool. I'm going to invest on Tuesdays. Well, Tuesday might be a really green day. And I'm like, well, maybe I should have did it on Monday. So next week I move it. I'm like, okay, I'm gonna invest on Monday. Monday is really red, but there's supposed to be a Fed meeting on Tuesday. And I'm like, okay, well maybe the Fed so I end up getting my head and then I wait and then like all kinds of stuff. So I was like, I'm just gonna put a little bit in every day and not worry about it. Like it doesn't matter to me. So again, like I practice what I preach. Like I know I can get in my own head, so I'm just gonna okay, how can I avoid this? One of the things that is really cool to do, and like I said, I haven't done it yet, but when you buy a stock and the cost basis goes up, which obviously everybody would love their cost basis to go down, but they'd also love to make money, which those things don't work together. But they want their cost basis to go. So if your cost basis goes up, for me, my cost basis on Costco is like 524 or something like that. It's really cool if you go on, Google, drag the price back until you find what your cost basis was and basically say, hey, this is basically like me starting my position 8 months ago in Costco,
right.
which is just another way to look at it, where it's like, hey, I bought it today. It's really quote unquote expensive because Costco is always way above its PE, but yet it always makes more money. So it's one of those things, and I'm just like, okay, cool, yeah, your cost basis did go up, but it's almost like you started your position 8 months ago based off of today's price. So yeah, you did buy it very expensive, but your price is still 8 months ago's prices, which is really cool.
Yeah, it does. It really just speaks volumes to me. One of the more fundamental things. A lot of times, you know, what what's cheap is usually not is cheap for a reason.
Mm-hmm.
What's not cheap, really not cheap. The great ones are never on sale. They're never cheap.
Yeah.
Sure, tanks. If we ever get a correction again, Costco will go down. It will go down somewhat significantly. But I always say, will people be brave enough to step in? Because guess what? Even the great ones, Costco, name some of the techs in there. People are still going to say, oh, gee, it's still expensive. It's still relatively expensive
Mm-hmm.
compared to the market. And they might get attracted to the bottom feeders, the zombie type companies, the no growers. People just can't grow.
Yeah, yeah, that's one of the. So I made a video. It was mainly to be. I do believe in it, and I follow this strategy. But it was mainly I was hoping to get like more, I don't want to say clickbaity, but more viral off of this video that I did. But I made a video called "Stock Price Doesn't Matter," and to me, the reason I outlined that stock price doesn't matter is because of two things: fractional shares and dollar cost averaging. And obviously,
Right.
it matters way more the closer you get to the end goal. But if you have 30 years left in your investing game and you're buying a company that you think may or may not be at the same price 30 years from now, that's not a company you'd want to buy. Like I'm
Yeah.
buying Visa and Costco and APD and AbbVie and Apple and Microsoft and stuff like this. I think there's a 0% chance it's anywhere in the ballpark of where it is 30 years from now. Like it won't be
Yeah.
close. And if it is, it's because they've done hundreds of stock splits. Like that's the only reason it's going to be close. So it's one of those
Right.
things where it's just like because I buy every single day, I buy a little bit every single day. So literally I'm like, okay, I have, $87 to put into Apple this month. Cool. I have 13 trading days left in February. So 87 divided by 13, I put however much that number comes out to every day into that stock. Just to take the emotion out of it. And it's yeah, and like I said, that's the dollar cost averaging. And then now, like one of the things that didn't exist when you started was fractional shares. You don't need to
Yeah.
have $187 to buy a share of Apple. You can literally put $1 into it and get your skin in the game.
Yeah. Yeah. Fractional shares, I think, a total game changer. And I love hearing what you do. Just that daily buying mindset. A couple guys on Twitter put me onto the 52-week challenge with the stock. And I did that last year with SCHD. All right. I bought it for 52 weeks, bought more each week. It built up, and it turned out I had some major rollovers of 401ks to do, and I put a very large sum into SCHD. I had been eyeing it for a while. But Troy, what I'm getting at is this year, in January, I started a 52-week challenge on two stocks I wanted to buy, and I wanted to take the guesswork out of it.
Mm-hmm.
So even just before we recorded this, it's Saturday morning. Monday morning, I have my week 7 buys in on these two stocks. I don't care what the market's doing. One is Coca-Cola. I told you I started buying that in the early 2000s. I haven't bought Coca-Cola since maybe 2012, 2014. I've just owned it, let it compile, and continue to compound, although it hasn't really grown as much. But I take my 3% dividend and take my ball and go home every quarter, which I love. You know, been whole sharing for years now. But I wanted to add some Coca-Cola here. I like the value of it, and I wanted to take the guesswork out of it. Hey, let me wait and see if it goes back to 54. Let me see if it goes to 57. Nope, just buy it every Monday morning at the open. The other one is a true growth stock, and I started buying this in November in the 20s and maybe the low 30s. And I said, I want to build a big position in it. I've got high conviction on it in 5 years. And it's going to be a typical Costco case. It's always going to look too expensive, more expensive than what I ever want to buy it. So what did I do? I put that on the 52-week challenge. Every Monday morning, I buy it. And don't you know, damn it, Troy, every week I'm buying it. I know we've been on an up and to the right market all year, but it goes up higher every week.
Mm-hmm.
But I'm building my position. And just automating it, taking that psychology guesswork out of it, it's so powerful, especially if you're young, especially if you're like, in your 20s or 30s. It's not going to matter if you're buying the right names and the right companies.
Yeah.
Just do it. Don't be scared.
Yeah. So, I mean, don't leave me in suspense. What's the other stock?
Okay. It's Cava, Cava.
I've heard it. That's
So
it's almost like a Chipotle, right?
almost like a Chipotle. It's a fast casual Mediterranean chain, founder led. Done a lot of research on it, and if anyone's listening, do your own research before you buy it. It could be a bumpy ride, but profitable. Second quarter after going public, expanding, great compound annual growth. I'd say very similar margins to that of Chipotle. And I really like the successful. I generally don't buy restaurants because they tend to be fatty. They go hot and cold. I've seen some great restaurant chains, and you look at them now, it's like, oh my gosh, in the 90s, everyone said you had to own Cracker Barrel. You haven't wanted to own Cracker Barrel and things
since
like
the
that.
90s. Yeah.
They just fade. They don't have staying power a lot of times. But in my portfolio, I manage my portfolio to a beta of about 0.86. That's where I am right now. So at my age, I design it in a way I'm perfectly cool not beating the market. I didn't beat it last year, but I outperformed it in 2022. Right? I don't need a 1.3, 1.2 beta portfolio. So what I do is there are 3 or 4 holdings that I have that's like, which one of these is not like the other one? And I've got a couple. I own some Tesla now. I own some Kava. I own Meta at $19 a share, and I joke, hey, it's my favorite dividend stock now that they're paying their first dividend. Yeah. But so I own a few of them like that. But in composition to my whole portfolio, Troy, my portfolio is a beta of I just added it up at the first of the year. I think it was about a 0.86 on the weighted average, because I've got things like Hershey in there. I've got some REITs in there. It just balances out. But really like the Kava story. I'm not going to jump on your channel and turn this into a stock picking, growth picking. I'm not going to hijack it with growth stock picking, but that's why I own it. It fits into my portfolio. I had room in my beta to buy something that's going to be a little bit aggressive and not pay a dividend, because I'm only 55. I still need some growth.
Yeah.
Some excitement.
Yeah. I mean, that's pretty cool. I like the and like you said, it's I was gonna do something like that where it was like every Monday morning or whatever, and I was like, okay, well then like something happened where the market went up too much, and I'm like, is it supposed to So yeah, mine was just daily, and so one of the ones, and you might know about. It seems like everybody I talk to about this one, it either scares them away because of what I'm about to say, or they just never heard of it. So there's a new thing. So I in my Roth as of the end of December, I had QQQJ, which is the Nasdaq Next Gen, and
Yeah.
QQQM. QQQJ wasn't doing well for me. I didn't like that. I mean, that's more like small and mid cap from my understanding. So it wasn't doing well. I had exposure to the Nasdaq already, and I was like, do I need this? So I ended up repositioning that position, and that one I did sell. I think I was down, I don't know, 2% in this position, whatever. So I ended up selling that, and one of the I don't even know if you want to call it an ETF. I guess it's an ETF. One of the ETFs I focused on was UPRO. Have you ever heard of that?
I don't think I have. No.
So and this is the first time I've ever bought this before. It is a triple leveraged S&P 500 tracking ETF. So therefore, whatever the S&P 500 does, it does 3 times that. Good or bad. If the S&P 500 is down 1% on Monday, this is down 3% on Monday. But also, like to me, it's almost a no-brainer. So it has an expense ratio of like, I don't know, 0.9 or 1% or whatever. But if you pull it, so dividendchannel.com is one of the websites I use all the time. So I use that. I put in like the longest history it'll allow you to do. And you put in UPRO and compare it to the S&P 500. Over the course of any long period of time, the S&P 500 goes up. I think it's over the course of 20 years, it's never had negative period or something like that. If that's the case, no matter how much it goes down or goes up, the S&P 500 always ends up. Therefore, this fund should always end up. When you use Dividend Channel, it actually factors in the expense ratio when it does it. This thing's crushing the S&P 500 over the long period of time. And I didn't look at, what's it done the last year? Like, give me long periods of time because that's what I have.
Right.
So that's in my Roth now, and it's just so like I said, I only have 6 ETFs and one in Tesla. So 40% of my portfolio is VOO in my Roth, and then 10% in all the other ones. So like it sounds like a big percentage, but like when you only have so many holdings, it can only be but so much percentage. Like I have to get to 100 somehow. So yeah, 10% sounds like a lot, but it's the same as all the other ones. And I'm just like, I'm up, I don't know, 23% on it already this year.
So if you saw my eyes roll back or spinning there for a second, that's exactly what I was calculating, Troy. I'm like, gee, the S&P 500, yeah, that's very leveraged, but there is an upward bias through the history of time.
Yeah.
Catch it at 3 times, and to be a younger guy like you, yeah. I mean, not that I'm sitting here judging,
Well,
but
it's one of those things that you were saying before about like buying it like it's what that's a you think your emotions are bad with a one times no leverage stock, like it just follows the stock. Like imagine it. So that's one of the things where like Friday the S&P 500 was up. I was up like I don't know 2.5-3% on UPRO. So it was one of those things where like, do I want to buy it today? Like, do I only want to buy it on the days where the S&P 500 is in the red or whatever? I took all that out. I buy my Roth every day too. And it's literally, I think it's $2.36 into that position every day. Something super small like that. And it's just, I'm just going to let it go. It's in the Roth, so it's tax sheltered. Anything it turns into is, scot-free kind of thing. So, I'm just playing, like, again, not financial advice, whatever kind of thing, but it's, it's just one of those things I'm playing with, and we'll see in 30 years or whatever when have access to the Roth IRA money, what it does.
Yeah.
Yeah. Okay, so we went on a little thing there, but so next question for you is, since you've been investing in dividend investing for so long, what would you say is your biggest dividend related mistake that you've made? And more importantly than the mistake is, what lesson did you learn and apply to future trades or whatever so you don't make that mistake again?
Yeah. So it's funny. I'm going to take this a little bit away from dividends because I think it fits both dividend and non-dividend stocks. About a little over 10 years ago, the biggest mistake I I think I learned and overcame was I had an individual stock selection strategy. I would go basically go big or go home. I would get very concentrated in an individual stock. So, I had my core investments, mutual funds pretty much back in the day that track the indexes. But one of the things I would do, Troy, one of the strategies when I would pick a stock was, remember, I really wasn't buying dividend stocks. And I would buy stocks that were, I hesitate saying this because I don't want anyone to apply the strategy because they're going to blow themselves up if they don't know what they're doing. But I'll just put it out there with that caution, put that warning out there. So, what I would buy is a thinly traded stock, small float. It's almost like short squeeze trading. I'd look for some sort of catalyst or potential fundamental. And here, how I came into this was there was a company about 20 years ago, it still exists today, called Jones Soda. This this got popular right around when Monster was doing well, but Jones Soda was trading at $1 or so a share. I forget how many shares it had outstanding. It may have been 40 million shares. So a thinly traded stock. So one of the things I would do is I would look at, all right, there's 40 million shares outstanding. Let me see how many are in the publicly availably traded float. Once you back out the insiders that own it, institutions, you can get down to a rather small number from 40 million. Maybe you're down to 8 million. And then you go a little bit further. Float turnover. How many days is it going to take for this float to turn over? And maybe if it trades, 400,000 shares a day, it's like, aha, every 60 days, the stock is turning its float over. So what does that mean? From a technical standpoint, that tells you you're breaking through a lot of the resistance. So I was looking at the fundamentals, but very heavy into the technicals. And one of the catalysts with Jones Soda was they were going to go mass market. Instead of just being in these like boutique type stores, they were hitting Walmart, Target, Sam's Club. And I knew that was coming. And don't you know, that stock went from one and change to 34 in about maybe 90 days. And I caught most of the meat off the bone. Maybe my average cost was about a buck 30, and I got out around 31ish or something.
Wow.
Thousands and thousands of shares. So that was a mistake because I ended up doing well a lot of times following that strategy, but it was like you had to get out before the barn door closed. Because if you didn't, guess what? Jones Soda trades at 40 cents a share today.
Wow.
Jones Soda probably never saw $3 a share after that run up, because what ended up happening is, yeah, Walmart, they had they put Jones Soda in all the Walmarts. You can sell to, but they couldn't sell through. They couldn't keep the sales cycle going. And after a quarter or so, the numbers didn't live up. So that's a mistake. And I think that applies whether you're looking at a dividend stock or a non-dividend stock. It's that same mindset methodology of building building some sort of mousetrap that's going to beat the system. It didn't work. One of the reasons I got it was, you want to talk about having sweaty palms every day. I'm looking at level 2 quotes, see how many shares are out in the bid. It just wasn't fun. I'm
Yeah.
getting to be closer to 40. I had to stop that. Fast forward to today, I have to count it up. I'm at day 2400, give or take a few days, since I've actually sold a stock.
Wow. That's cool.
I, I only I only buy I only buy stocks that I have conviction in.
Yeah.
That and something like Coca-Cola, just because I didn't buy it for the last 10 years didn't mean I lost conviction of it. There were other positions I was looking to build. So that was a lesson I learned, and I think it's made me a little bit more successful as a dividend investor. And then even some of the stocks that I have right now that don't pay dividends. Well, Meta pays a dividend. When I was looking for a growth stock like Meta, it was Facebook at the time, IPO'd at 31, waited a few quarters, liked the story. It looked good long term, did the same thing with Uber. IPO'd, went to like 42, never saw close to 42 again for a while, bought a heck of a lot of it in the 20s and low 30s. Here we are, 70 something, love it. And guess what? It's worked out 2 times. I'm going to try going back to the well, doing the same darn thing with kava, because I think it has that, it kind of fits that description. But when I buy something, Troy, I go into it. If I don't think I'm going to own it either forever or for a very long time, there's 4,000 stocks out there.
Yeah.
There's no way I'm going to research all of them. There's only a small handful that meet my criteria. That's why I have the Dandy Dozen in my portfolio. If I don't think I'm going to own it forever, I'm not going to own it for a minute. Simple as that.
Yeah, that's a really good takeaway with that. Is if you're not going to own it forever, don't own it for a minute, kind of thing. Because so many people are, I mean, another strategy that you hear often, which most of the time doesn't work, is like that dividend capture strategy. People buy right before the ex-dividend date and then they sell right after, and that also doesn't work. It's just like you said, different mousetraps, different ways to try to game the system, and people just
Yeah, I paid my dues. I did it the other way. Got to be the fastest guy getting into the stock and the fastest guy getting out.
Yeah.
Didn't like it. Couldn't live that way forever.
Yeah. I always like asking that question because selfishly I get to learn, one of the points of this series, other than, like I said, it's easy to edit and stuff like that. One of the points is there's going to be takeaways that I can add to my own strategy. And one of the things with what you were just saying, and one of my interviews earlier with Dave Maloney, he was saying that his biggest regret, his biggest mistake was selling stock. He goes, I bought it for a reason. And he goes, I lose conviction, or I'm up a lot in it, or whatever, or it doesn't meet my metrics or whatever. And he goes, I sell it. And then it skyrockets afterwards because I bought it for a reason. It was a good company. It just had a bad stretch. And saying that's what I'm doing now. That's why I'm having the active and dormant strategy. Okay, it's not beating right now. Let's put it on hold. I don't need it. I'll still drip it. I'll still let it do its thing. But until it starts meeting my metrics again, and maybe I'll set a thing where if it doesn't meet my metrics for like a 5-year period or something like that, then I can reevaluate or something like that. Because that's one thing I do think is important as an investor or dividend investor, is setting your metrics, making sure they're easy to understand, making sure you can actually follow them. That's the most important thing. And then also being able to mold and reevaluate and reconsider things. Like, it's not something that you set when you're 20 needs to be the same when you're dead. There's things need to change as you learn and as you mature as an investor. So
absolutely.
Yeah. Okay. So I'm curious this for you, since you are not counting, but a little bit over 365 days retired. What are some of your short-term goals with your portfolio? Like, what do you hope to accomplish, let's just say, in 2024? And then what are some of your longer-term goals? Because now you've reached the rainbow at the end of the road kind of thing. But what do you hope to do in 10 years? There's still more meat on the bone. So what do you hope to get out of that?
Absolutely. So, what my short-term goal is not to blow myself up, which is why I keep myself very, I don't want to have to go back to work. I still do side hustles. I'm only 55 years old. But the beautiful thing is, Troy, whatever I do, I'm doing what I want. And it was pretty interesting. The unintended, we're talking a lot about wealth and wealth building. The other consequence is health, keeping yourself. All right. So I got a history of high blood pressure, heart disease, all the fun stuff in my family. We either, my family lineage, we either make it through our 60s or 90s. There's no in between.
Yeah.
I want to beat the odds. I still, make sure I exercise, things like that. Well, the reason I'm bringing this up on a short-term basis, for about 7 or 8 years, I was in a high stress, high responsibility position in financial services. Troy, I struggled with high blood pressure. It wasn't like, it was like borderline high for my age. Oh, I try to eat better. I try to exercise, but the stress of the day to day, man, that's why I had to step away. I had enough money. And don't you know, I had my blood pressure taken about 3 times recently. I got a bad cold, had to go to the doctor, annual physical. Don't you know, my blood pressure, it's the best it's been in 20 years. Completely normal. I'm not taking medication. Sure, I'm eating a little bit better. I'm going to confess, not much better. And yeah, I exercise a little bit, but stress is a big thing. So that is a short-term goal. I really want to enjoy this period through my 50s and through my 60s, just in case. I'm set up in a corner right now that I typically wouldn't do a video podcast because my wife and I are downsizing from a seven-figure 5,000 square foot home. We're empty nesters. Our daughter's away at college and about to graduate. I've got all my responsibilities paid for, and we're moving to a house about half the size, 2,700 square feet. Still plenty big for a empty nesters. And so simplifying a little bit, keeping it simple, not touching my nest egg, my seven-figure nest egg that we've built. Um, I'm using the next decade to continue to compound, right?
Mm-hmm.
To continue to compound dividends. Probably not going to add a whole heck of a lot of stocks. And I talked about it earlier, managing my portfolio to a beta, a little bit less risk than the whole market, because I don't need to take a tremendous amount of risk. I don't need to beat the S&P. If the S&P puts a 20 spot up on the board this year, I don't need to outperform it by 25%. I don't need it. If I walk out the door with 15% this year, I'm king. I'm golden. So I hope that answers your question. That gives a little bit of a little bit of a glimpse. Sure, I could probably live off of dividends in not quite 5 years, definitely 10 years from my portfolio. But if I can't or don't have to, I can do a little bit of a withdrawal rate from the growth of my portfolio at that point too. So there's a lot of flexibility, I think.
Yeah, yeah, that's super cool. It's always really cool just to see like the different strategies and goals people set. Because at the end of the day, like I give this all the time is like so I actually I'll touch on that later. I'll remember because it's one of my favorite things to say. So do you have any? I know you said it's been I forget how many days you said. It's been a lot of days since you sold a stock. Do you have any stocks that you remember selling that you regret selling, or any stocks that you want to brag about buying, kind of thing?
No, none I regret selling, because a lot of the stocks I was selling, you better have you better have an exit plan, a plan to sell. So no, any of the long term um, stocks, there's nothing I regret buying. I almost sold Uber a little over a year ago, I guess, when it's finally started punching into the 40s. I was like, well, this, but that's the CEO, Dara. I'll tell you what, every quarter, don't you know that guy for the last 2 or 3 years? He's a CEO that matters. What he says he's going to deliver on, that company delivers on. And sure enough, I'm glad I held on to it and not let that one get away, because who knows? I could see that being a dividend payer in 5 years.
Mhm.
They're going to be a cash flow machine. They are a cash flow machine. There's one yeah, every stock in my portfolio I'm happy with. It's like a team. It's like I'm fielding a football team, right? I've
Mhm.
got I've got um
Well, you got 12 men on the field though, so you're gonna get penalized.
I've got yeah, I got 12 on the field, but uh, I'm trying not to get a penalty called on me. You know what I'm saying?
Yeah,
They all play purpose, right?
yeah.
So people will chastise me. Well, you have Realty Income Corp. At 75, everyone was saying, "Oh, that is great." At 53, you don't have as many friends when you own Realty Income Corp at 53. But do you not realize when you go through a portfolio, I cannot own a portfolio at my age that consists of NVIDIA, ARM, Tesla. I can't have a Mag 7 portfolio. I don't need it.
Yeah.
Just like I don't 23-year-old should be investing in Realty Income Corp. I don't think a 55-year-old should be building, I'm not playing catch up. I'm playing defense here. So it, it, you know, I get why REITs are down right now. Hey, they tracked down about 10% over this year. 10 years up about 40 basis points, 35 basis points in the last 6 or 7 weeks. And it's interest rate sensitive stuff. We're always not going to be in this, we're always not going to be in this environment. So I always try to step back and say, you know what? And I think we're saying this, you said this a little bit earlier, about people that sell stocks. Recognize the environment we're in
Mm-hmm.
right now, not the environment we're going to be in.
Mm-hmm.
Both good and both bad. Don't get too S&P 500 giddy. Don't get too cautious on certain things. Just don't be that rear view. Um, don't be looking forward. The windshield's bigger than the rear view mirror for a reason. Don't always be looking behind, chasing past performance. Look at where you're going.
Mm-hmm.
Let your your portfolio to where it's going to take you. Your portfolio is not going to be my portfolio, and vice versa. The hundreds and hundreds of people that look at this video, there's going to be things they agree and disagree with everything that we said, and they should. That's perfectly normal.
Yeah.
If you agree with everything a person is saying, you're not doing your thinking, you're not doing your due
Yep.
diligence. Take a break, step back, call a timeout.
Yeah. Yeah, I agree with all that. And at the end of the day, you could always say that your big position in realty income is so you can identify more with the younger folks, since that's all they hold. You're just doing it for them. You're just trying to be a younger guy. That's all. You want to be a 23-year-old and have realty income. Okay, so one of my other favorite questions is, so we know that investing is a long game. If you quote unquote do it right, investing is a long game. Dividend investing,
Right.
one could argue, is even a longer game, because sometimes the growth isn't as high as just a purely growth stock. Like Meta before the dividend, like Meta and Tesla, those are the stocks you buy just for growth. And then you have your just dividend stocks. Then you have the beautiful blend in between of dividend growth stocks. So like, since we know the game so long, what role do like milestones and achievements, like getting those, what role do those play in keeping a person motivated?
It's funny. I remember. So I talk a lot of stories and parables. And Trey, one of the biggest things I remember is years ago, I was out at a dude ranch, kind of a company retreat out in Arizona. And out in Arizona, there was a lot of saguaro cactuses. Those are the typical cactuses you see people draw sketches of or cartoons,
Mhm.
right? And it takes like 100 years for one of those big cactuses to form. It's not like back east where we have a tree in like 5 or 10 years. It just, it takes off and you got leaves everywhere in the fall. Patience, 100 years. But I remember out on this dude ranch, we had a guide, and he was taking us through the desert. Don't you know? I wasn't watching where I was going, and I stepped on a cactus.
Mm.
You, when I stepped on it, what I'm saying is it couldn't have been a couple inches high. He said, "Well, there goes." He said, "There goes 20 years down the tubes." I stepped on it and crushed it. It basically took 20 years for that little nothing nub of growth. And right 50 feet away, I'm looking at a cactus that probably took 100 years to grow. That's standing, I don't know, 40, 50 feet tall. I tell that story because it's just like investing, whether it's a growth stock or a dividend stock. We we, we're looking at our holding today. Oh gosh, I bought Pepsi. I have 23 shares of it. They had a rough quarter. Oh no, sales are going to be down 3%. Blah blah blah. We're looking at that little cactus. What we're not looking at is, what am I buying Pepsi for 20 years down the road? I'm going to be whole sharing every quarter.
Mm-hmm.
That little nub of a cactus ain't going to make a difference. Ain't going to make a difference 20 years from now when you're sitting fat in the right stock.
Yeah.
So if you can keep that level of stoicism, if you can keep that level of mindset to you, don't get too caught up in today. It ain't going to matter what you're building today. You're not building it for today.
Yep.
It's the bridge you're building. That is the biggest obstacle. I don't care what you're analyzing, the fundamentals, the technicals. If you can arrest yourself from that, you're going to win.
Yeah. So two takeaways from there is, one, don't step on the cactus.
Yeah.
Did stepping on the cactus hurt? Did it like poke through your foot or
I
anything?
had on or something, so I didn't feel it. But my lumbering around my big 200-pound self on a wearing cowboy boots and on a 6-inch cactus. I mean, there went 20 years of growth down the tubes.
Wow.
Killed the whole thing, I guess.
Yeah.
He was making a point. So yeah.
Yeah, well, there you go. Yeah, that's a really good story, because like I said, that's one of the reasons why like I don't like we were talking about Costco before. I don't know if this is like this on Twitter or not, but or X. Um, I've seen so many people in Facebook groups, like Dividend Facebook groups on there, where they're like, they identify that they want Apple at 126.10, and they will not buy it until 120. First of all, they run some numbers and metrics and whatever, and like that's how they come up with that price. And I've actually I think it's two different people that I've spoken to where they never got to own company whatever because they wanted it to hit a certain price and they didn't. And I'm just like, that doesn't make it like that to me. Okay, say it was 2% higher than 126.10, this price that they came up out of nowhere. They missed out on hundreds or thousands of percent gain because they wanted to save 2% on something that they're going to hold for the rest of their life. And I'm like, that doesn't compute in my brain. I don't get it.
It doesn't. It kind of reminds me when we go shopping for something, buying airline tickets, hotel reservations. I won't stay at that. I'm not going to buy that. I'm not going to buy that. I'm not taking that trip. The airline ticket was $389. I was looking for $379. No, you wouldn't do that.
Yeah. You're like, oh, I
Right?
guess this is just the price. Like, I can't find anything cheaper than that, so I guess we're gonna settle for that.
Grocery shopping. No, we're not eating this
Yeah,
week.
yeah. Gas is a little bit. Imagine that. Imagine you need to go to work and gas is more expensive than it was last week. You're like, oh, I guess I'm not going to work this week. Gas is too much. Call the boss. Tell him I'm using a week of PTO. Gas is too much. Yeah, I don't know. It just doesn't make sense to me. And like that, like I said, that's why I made the video. Like, stock price doesn't matter. There's so many. Again, it matters more if you're going to start a new position. You're 65. You need the income, or you need that position to do well from this point on. Like, you can't, if you're 65 and you only live to 75, you can't allow a 20-year period of the stock going down, because then you just lost money. But if you're 25 and you're over here worried about the technical analysis or where it is relative to the 200-day moving average and stuff like that, I'm like, dude, you have 70 years of investing left. Like, if your cost basis, assuming you only bought it once, if your cost basis matters that much between being $73 and $72.50, you're doing something wrong. Yeah. Like, I just don't. Obviously, the goal is to have, hundreds or thousands of shares. I get it, but like, still, like, it's 50 cents, and the alternative is that you never own it at all. Like, it doesn't. I don't get it. So, a question I'm really, really curious for with you is, you were able to retire, and you retired. What the society would consider early at 50. You said 53 when you retired.
54.
Okay, so 54 when you retired. So your retirement was because you could financially, and also because of the high stress environment of your position. Yep. Other than that, like, how does somebody know when enough is enough, as far as like with their dividend portfolio? Say their goal is to live off of their dividend portfolio. The thing that we talked about hundreds of times already is the power of the compounding. So like, if you see, okay, this year I'm going to make $74,000 in dividend income, but if I wait one more year, that'll go up to $82,000 in dividend income. So like, when do you know it's time? Like, when's enough?
That's it. Enough. That's the biggest word. When is it? It's always a question I throw back to people, and not so much an answer. I don't know when a person's enough is. I think you have to really be honest and answer that question for yourself. For me, it was, I know I could replace most of my income if I had to. I can't or shouldn't at age 55 because I could outlive my money. There's a risk for that. Another risk personally for me was, I'm only 55. Now I'm 55. We could have a downturn. We could have a lost decade. It's possible.
Mm-hmm.
It's I'm not saying it's going to happen. I doubt it's going to happen, but even if the chance is low, the chance is not zero. So you don't want to be one of these people that, well, yeah, you retired and got out early, and now you're living off your investments. The market's down 40% and it ain't coming back. Your expenses are still high. Now you've drawn down your whole portfolio. Guess what? You're going back to work at 65. Like, who really wants?
Mm-hmm.
People don't. 55-year-old workers. Who the hell wants a 65-year-old worker? It's not going to do it. So I think you have to define yourself both. If you look at the number, that's important. I think another factor you want to consider is some of the less quantitative things. Look at look at some of the qualitative stuff that you want. Like, what do you want to do? So what I wanted to do was build um, a social media. I have a lot of experience helping people invest, getting them invested. That's how I wanted to give back. You know, it's funny, when I was working in financial services, I was no longer helping people invest. I was in meetings, handling regulatory oversight stuff, boring stuff, Troy, boring,
Mm.
not what I want to do. So it was time to step away. Um, so I wanted to help people from a social media standpoint start investing and start my podcast, which has been great. A great experience too. And the next thing I'm going to do, now that we're completely, I don't have a bill in the world. You know, if I don't want to, if I want to turn my lights off, I don't have a bill in the world.
Yeah. That's
That's where I want it to be. That
that's
was
the place
enough.
to get to too, because like when the wife and I combined our finances, like a lot of times people always combine their finances, and the first question they're asking is how can we make more money. The wife and I's first question was how can we reduce what we're spending.
Yeah.
And I feel like that's just a big not necessarily a mindset change for us. Like that's how I've always thought, is like, okay, like we're spending for example, for like the Ring doorbell, I think it's like $39.99 a year. But like I realized we never really look at like previous events on the Ring. Like we'll get the alert on our phone, we'll open it up, see who's at the door right away kind of thing. And like that's what you're paying for, is you're paying for that storage. And we have security cameras on the house anyway. So if I needed to see somebody stole a package or whatever, I can pull it up on there and I have it anyway. And that's free. So I was like, okay, like that's $39.99 a year that I don't need to spend. So we canceled that and stuff like that. So it is what you're talking about with like having no expenses. Like that's the trick, is like no matter how much you make, if your expenses are always keeping up with what you make, you're always going to be the same level of broke.
Yeah, I credit my wife for that. I was really good at the making part. She was good at part of like controlling the expenses really good. And some people get so, you're never going to save yourself to wealth.
Mm-hmm.
And you could build wealth, but really, really try going down that down escalator where you're spending so much money. You got so
Yep.
much going out. You're working at it. So I credit my wife for doing a lot of that. It's funny, a good story. This just happened the other day. I said, we're moving. You know, I started thinking logistically, we're a month out. We've got movers and everything, but, you know, we might need a storage unit to put stuff we don't want to go on the truck. And it's going to be too cumbersome to start taking in carloads. I said, I said, why don't we just get us like a 10 by 15 storage unit for a month? It's like $111. And my wife was like, $111. And I had to talk her down. It's like, one, we've got the money. Second, it's gonna make things logistically simpler for us. And then I fortunately learned to apply a skill that I've learned in real life. Well, if you don't think that's a good idea, what would you propose, honey? And she couldn't come up with an answer. She's like, well, we can get a rental truck and get on a U-Haul. I said, well, you know, it's going to be just as much money to do that. And it's going to be more logistically a nightmare of having to move 3 cars, and then also a U-Haul, and have like a day to operate with. Let's just give ourselves the flexibility. So I forgot why I got off on that tangent, but it's a good story of just controlling expenses. Don't let them control your expenses. Don't let them control you.
Mm-hmm.
But be afraid to spend sometimes too,
Yeah.
when it's simplified.
Especially like you said, when it's simplifying or when it's like helping with the stress management and stuff. As far as like if you have to spend an extra $10 to make something in your life way less stressful or way easier, it's definitely worth it to do so. It's the key for you guys is going to be making sure that you limit yourself to that 1 month and get that stuff processed and stuff, and that way you're not that's how people end up turning it into, oh, I've had this storage unit for 3.5 years worth of stuff I don't use anymore. My grandma and my dad are like that, where they just had like my grandma moved in with my dad. And she had a storage unit worth of stuff that she thought she was going to use again. I'm like, okay, now you've been paying for this storage unit for 7 years. You have a couch and a bedroom set in there that like you're never going to need again. Like why you're not only are you paying $100-$200 a month for this storage unit, like now you don't need, like you're just wasting money. So just don't let that happen. You gotta get rid of that storage unit. You don't need all that stuff. Yeah. They always talk about moving's like the greatest way to like declutter your life. Like you should just move like yearly and just you wouldn't have any stuff.
Yeah. It's been such a decluttering experience.
Yeah. Well, you
Yeah.
guys have been in that house for I imagine a while, right, with the kid?
Um we stumbled into this house probably about almost 12 years ago, like at the bottom of the housing market.
Uh-huh.
They were basically giving this house away. It was bigger than we needed, and I remember closing, signing all that paperwork, and I felt like I was writing checks to myself. I was like, damn, we're going to score in this house. We're going to
Yeah.
score in this house. And sure enough, we did, and didn't have much of a mortgage to begin with. And we only had a 3% mortgage. And people were saying, that's the dumbest thing in the world. Why would you get rid of a 3% mortgage? You can you can put your money in a HISA and out earn that. I'm like, yeah, if you only live by a spreadsheet, and I live by more than a spreadsheet, that makes total sense. But I I'll have some posts coming out about this from my mindset on it. You can't put a price on freedom, true freedom. Well, you'll still have property taxes and homeowners insurance. Okay, yeah, I will. Unless we move into a van by the river, I can't think of a way
Yeah.
to
Yeah.
bypass. So I'm thinking, what's your point? Freedom. Everyone talks online about financial freedom and being personally free. This is, I mean, these are the things this is what it looks like, man. This is what it looks like, at least for me. If we want another mortgage, we'll go out and get one, I suppose.
Yeah, yeah, I agree with that because I'm almost in the same boat. Like the wife and I are gonna be. We wanted to rent this house that we're in. I have a 2.75% mortgage, or interest rate on my mortgage, and it's. I know the right financial decision is to keep it, rent it, and just get like the next mortgage or whatever. But one of my counter arguments, and it's one of those things like enough to like counter argue almost any argument kind of thing. Same thing with me. I mean, obviously there's always more we can know, but like my counter argument to like because other people, it's the same with the stock market, right? People are like, oh, well, don't buy it. Especially for us, we're going to have a mortgage on the next house. And they're like, well, don't buy yet. Like the housing, whatever. I'm just like, okay. But like, you can always refinance and stuff like that. I'm like, I'm not going to let the current rates and stuff. But like, one of the ways to combat the 5.5%, 6% interest rate that we're going to get on our next mortgage is by putting more down. So if I can sell this, yeah, I lose my 2.75% interest. But if we have 100K that we saved and then we get 150K in equity, we put 250K down on a $300,000 house. I have a 50,000 mortgage at 5.5%. That's not bad. Like versus not selling this house, only putting 100 down. Now I'm getting $200,000 mortgage at 5.5%, which might actually be more because you're borrowing more. So you might actually get like a 5.75 or a 6% because you're borrowing more money. So I'm like, no matter if you're a spreadsheet guy or a realistic guy, like there's ways you can argue around both ways. So I definitely relate to where you're coming from. Obviously we'll still need the
Yeah.
mortgage and stuff, but
6 months ago, when we went all in on this selling and downsizing and everything, it's funny, you made me think. The thing my wife and I really wanted to do was go ahead and buy a rental property, right? Buy a house, all cash. We're gonna have several $100,000 of excess cash. It's like, all right, we'll start buying. We've never been we've never been landlords. Troy, that's not my temperament. I can't do it. I can't buy rental income. I can't buy rental properties because it violates that fundamental rule. It's just you got to know yourself.
mm-hmm.
I just don't have the temperament for it. I don't enjoy the hunt and then the inspection and all the paperwork and the inefficiencies with the real estate. God bless the people that can really do it and do well at it. You earn every penny of that passive income. It's just not for me. I like looking at a stock, looking at its dividend, and just letting it go.
Well,
And
yeah.
then the other thing people tell me is like, oh, Tom, another thing is, yeah, just rent your house out because you could get about 4 times your mortgage
Mm-hmm.
or more on your house. Yeah, mathematically that makes sense. So what are you telling me there? Now I've got to be a landlord of my own in my house. And then if it's not rented out, I've got to cover it, which I could. I got to keep up with, no, I don't want to do that. Sure, I could do that. It's the classic case of, well, I've owned the S&P 500. I've owned the S&P 500 for 20 years and I've averaged 10.18%. But if you owned Bitcoin the last whatever years, it's always that you're doing one thing, you've done well, but there's always that one thing next door, right? You could do a little bit better. You got to break that mindset. You have to, sure, you could, but what's the best for you?
Yeah, and you could also the other thing that people don't realize is you could also do worse. Like there's the opportunity of like, yeah, here's the thing I'm gonna do. There's always option one that's better, but there's always option two that's even a worse decision. So like you don't always need to make the best decision. You always need to make what, like you saying, what decision's good for you. What decision is best
I,
for you?
yes, I call that armchair investing, and we're so good at that. We're so good at it on social media. Armchair investing, saying what should have been done. So I'll use Meta as an example. Boy, I was got roasted in the last week or two talking about, oh, I owned Meta at 19. I rode it up to 375. And then don't you know that thing went all the way back down to under 100. And here it is at what, 460. Well, I had people tell me, it's like, well, you should have got out in the 350s, 370, and then bought it back at 100.
Yeah. Had you known that, yeah, that of course.
You have, so, of course, yeah, of course. You have to have so many the switching costs. Like, would you have, if you've done one, would you have done the other? But I always answer it back with the question of, oh, how much Meta did you buy at night? Thank you for that suggestion. How much Meta did you buy at 19, sell at 350, and buy it, buy back at 95? The answer: crickets,
Yeah.
nothing. Armchair people,
Yeah.
posers.
That's such a good point. Is like everybody's like the hindsight. Like that's one of the reasons I try, and this is like one of the things I try to live by is like I try to make really informed decisions based off of the information that I have and the knowledge I have now. But at the end of the day, like I don't go back and beat myself up over a decision I made in the past based off of information I have today, because that's just not like that's not apples to apples. Like for me, for example, the last stock I sold, other than that QQQJ, the last stock I sold was Nvidia because it didn't meet my metrics. And this is before I had my active and dormant position. Of course, I sold it like 3 or 4 days before earnings when it went up like 24%. And like now it's up even more. But I sold that stock because it didn't meet my metrics. I took the gain. I was up 55%. I sold that. I started a new position in Costco. I got the special dividend. Costco is my best performing stock, up 35% or something like that. And I was able to put the additional money into the balancing out of the rest of my portfolio. So it's one of those things like, yeah, if I would have known Nvidia was going to go up, an extra 100% right after I sell it, of course I wouldn't have sold it, but I didn't know that. So I'm not going to beat myself up over that decision because based off the information I had at the time, this was the right decision for me. So I 100% agree with that. It's yeah, armchair investing is one of those things, and I do like your little rebuttal back to them. It's just like, okay, tell me more about like how you did what you're suggesting. Like don't like you're getting it from the armchair quarterbacks that we hear every Monday and talking about. Oh, this guy threw an interception. Like clearly you can see this. I'm like, yeah, clearly you can see that from the skybox, and you have that. But when you're on the camera with a 300-pound lineman coming down, like coming at you like that, like you're like, oh yeah, I gotta make the decision quick. Like yeah, I get it. Yeah.
I always want to learn. I have 30 something years experience. I don't have 1 year of experience 30 something times. I always want to keep learning. Tell me if you got a better way. I'm open.
Yeah. Okay, so a couple more questions for you. I know we're over our time, but hopefully we can get these done. The interview's been great. Okay, so I'm curious, what specific criteria do you have nowadays, or maybe even before when you were selecting, because you have 12 stocks, so like when you were selecting those 12 stocks, what criteria do you have to help you select those stocks? Are there certain metrics you're looking for, or what are you looking at?
Yeah, sure. I'm looking at the standard ones. I'm not going to kill you. I'm looking at revenue growth. I'm looking at earnings growth. If it's got a dividend, I'm looking for payout ratio. Not my style. I'm not going to buy something like 3M. I'm not going to buy something like Whirlpool. To me, that violates criteria. I'm more likely to buy a Starbucks, which I do own, and I think I've got an average cost in the 30s. A little bit of tough times lately, but I've been through the fear of the product innovation cycle. I can't tell you how many times I've heard, oh, the China growth story, the China growth story, all that being concerned, but I stick with it. If I have the conviction and believe in it, I will do. The other thing is, since 80% of my portfolio is in ETFs, and I use VTI and SCHD, especially with VTI, I sure I wish I've owned NVIDIA, but how much of VTI is in NVIDIA? It's got to be it's over 3%, right?
Yeah.
I haven't looked. I don't get. I only buy things, I call it oversampling, that I want to own in excess of what I own um, in one of my ETFs. I don't want to have to babysit a stock. I'll babysit maybe one or two at a time. I babysat Uber for a while. I don't feel like I no longer have to do that. I'm going to babysit Kava for a little while right now. Make sure the thesis holds up. But things like Coca-Cola, Starbucks, Old Republic International, Realty Income Corp, Walmart, which I've owned for 20 something years, Duke Energy had a rough quarter this quarter. I don't babysit those. I've owned them for as much as 20 years. So uh, that's kind of what I'm looking for. I never want to buy a stock for the story they might have this quarter. I used to do that, and my last stock I sold 2,400 days ago, roughly, was because of that. I got out of the stock with my teeth, and I'll never go back to that again.
Yeah. That's really really cool to think about with the just with you having the experience that you have and the background that you have, how you still don't overcomplicate the process. It's just really cool because I see so many people where they're like, I need this ratio and a price to book. Like to me, like I don't follow a lot of that stuff, but like PE ratio, price to earnings. One thing, so two things that are confusing about that is price to earnings is based off of the guesstimate of an analyst saying we think that the projection of the earnings is going to be this.
Yeah,
Analysts are always wrong. It's like literally every quarter. What do? We go and it's like, oh, is it a beat, a miss, an equal with the estimate? Like that's literally what these companies are judged by is whether they did better or worse than what somebody predicted they would do, which is wild to me. And the stock will trade wildly up or down based off of that random projection that somebody picked. And then the other thing is from sector to sector, industry to industry, specific stock to specific stock, you can't pick a PE that is perfect for everything, which is what bothers me. I don't like picking a metrics that's so variable all the time based off of, oh, this is in the energy sector. Oh, this is in the tech sector. Like those PEs are wildly different. And then also, like me and you were talking about before, is certain stocks are always quote unquote overvalued. Costco, I should have never bought it. It was overvalued. That was at 494 and now it's worth what, over 600, $700?
100. Yeah.
Yeah. So like it's one of those things where you never would have bought it because somebody told you, oh, according to our estimates, it's overvalued. Well, it's always overvalued and it always continues to outperform.
The one thing I'd suggest a person do when they're considering a stock, you made me think of it with PE, whether it's a growth stock or dividend stock, is when you look at PE or you look at earnings, um, which obviously is a part of the PE, look at guides. Are they guiding up or guiding lower? That's a more important trend to me because I love guide higher. A company like Costco is a guide higher story. Why it's always expensive. A company like NVIDIA, if you're a true, well, NVIDIA is a dividend stock. They're always guiding higher in this run. It's never going to be cheap. The guide lowers, look at some of your guide lowers. Names like 3M, Target, Disney, great names, but they've guided lower consistently over the last 7 years. What's happened to the damn stock? Well, you've missed the move in the market pretty much.
Yeah, that's a good point. So when you say guide lower, that's like the guidance from like the CEO or the management company saying, hey, we think it's going to be less of a
Uh,
performance this month or this quarter.
yeah, that, and then what you'll see projected earnings over the next couple of quarters, and that's where all the analysts they jump on the call, that the current quarter call, and they look out over the next quarter and the next year. Oh, based on sales increasing, instead of thinking between $1.10 or $1.20 a share. Now we're estimating $1.30 to $1.40 a share. That's a guide up.
Okay. Okay.
That's going to influence stock price. So that's a guide up. Important for two things: for a growth investor, also for a dividend investor, because where are your dividends going to come from? They got to come from, the company's got to be making money.
Yeah.
They're guiding up. Love
Yeah.
that.
It's just always cool, especially like I said, that's one of my favorite things you said so far is just like how you pick your stocks and how it's not super convoluted. Cause like sometimes I get frowned upon in the YouTube space because like I don't use fancy metrics. Like I don't know if you're familiar with my metrics. But I like outperforming the S&P 500 over the period of 10 years. Because to me that shows, that you can, your money's where your mouth is, you're a well-performing company and it's a long period of time. I like a dividend growth rate above 5 years, or not a dividend growth, a dividend streak above 5 years, because that shows that there you can, especially now during COVID and stuff, like you can have some turbulence and you can still pay and grow your dividend. And then I like a dividend growth rate 3, 5, and 10 years above 10%. Like those are my metrics. And if I had to make a fourth one, it would be a payout ratio below, I'd say below 50%, but the lower the better.
Yeah.
And it's just
I
like,
like the 50% too.
yeah, and to me, like I don't know if you're familiar with like Joseph Carlson and stuff. Like I think he's really smart. He knows all his stuff. But like to me, a lot of the so cool things with this, he gets really detailed and granular with all his stocks, and he looks at all his Qualtrim and all kinds of stuff like that, which is really good. But I feel like a lot, like he loses a lot of people because they don't understand, and some people feel like they can't invest because they don't understand some of that stuff, and that's not the case. And then the other thing that he does is, or one of the things that like puts a feather in my cap is a lot of the stocks that he looks up all the metrics that he uses. Him and I get to the same answer. No matter if it's 1 + 3 = 4, or if it's 2 + 2 = 4, we're getting to 4 regardless. And I'm like, that's cool for me because I'm able to simplify these metrics that still give us the same response, but they're easy to understand. And more importantly, like I said before, they're easy to follow.
I always tell people when they ask questions like, "What do you look at? What do you do?" It's like, I've got a CFP. I've got a master's in finance. If it feels better, I can make this really complicated for you. If it, right, but I don't think you're going to do much
Yeah.
better. The the more I try to be smart about it, the more I end up kind of outsmarting myself.
Yeah, yeah, and that's the case for a lot of people. So, like I said, I'm really glad you said that because it makes me feel better about myself. So, okay, so I feel like you're gonna have a good insight on this. So I've had a bunch of interviews. Some people don't seem to value this at all, and some people value it a lot. What role does diversification play for you? And like, how important is it? Do you think it's very important? Do you think some people over diversify or under diversify? How do you feel about that?
I mean, the principle of diversification, I think, is essential, especially as you get older. And I know a few people that I'm very close to. They're not that diversified. They've got basically the Mag 7 in their portfolio.
Mm-hmm.
They're 26, 27 years old, not that big of a concern. A person my age, you're going to kill yourself at some point in time.
Mm-hmm.
You're going to live by the three-pointer, you're going to die by the three-pointer. All right. But I think diversification is essential. And the most efficient way to pick up that diversification is through an index fund. It's inefficient, it's clean. You're going to be where you need to be when you need to be there, just by force. So I anchor a portfolio from that standpoint. And then when I want to further diversify, or supplement, that's where I start going in individual choices now.
Do you let the diversification of an ETF, so you know how like, VOO, for example, is, more into tech. Do you let that give you like the basis of how you start diversifying, where you're like, hey, I don't want to own a lot of tech individual stocks because I am so heavy in tech because of this ETF?
Great question. Yeah, from a technology standpoint, I don't play much big tech outside of that. Apple, I own that. And sure, Apple scares me now. Things are slowing, but I said the same thing in 2014. I did a whole pod on that episode. Apple's just like 2014 right now. The same thing happened in 2014. Slowing iPhone sales. Oh, and we're not sure if the watch it's a new product. We're not sure if it's going to make it. Well, 2024, here we are. iPhone sales are slowing, and there's something called Vision Pro
Yeah, that
that's
thing's
hitting
very expensive, but from what I hear, it's revolutionary.
in 2 to 3 years. It's not going to make a difference. It'll be the next product cycle. And then I think the other part I wanted to touch on with diversification is some people have 100 individual stocks in their portfolio.
Mm-hmm.
I don't know why. Why would you have 100 individual stocks in your portfolio?
Well, they grew up Pokemon fans, and they're trying to catch a ball, is what they're trying to do. Yeah,
that's the best answer.
that's. I mean, that's because like at the end of the day, like when I do my Power 5 series that comes out every Friday on the channel and stuff like that, it never fails. Every week there's a stock I mention on there that's very interesting to me. I don't own it, and then some people just like they don't want to have a watch list, and what I mean by that is they don't want to have a list of stocks that they like that they don't own. So they just see it, they identify it, they're like, I like that stock, I'm going to add it to my portfolio. And again, to each their own, but like when I first started, I had 36 individual holdings and 3 ETFs. Again, when I first started, I didn't have a lot of money. So I noticed that I had $211 in this one and $98 in this one. And I was spread so thin, I wasn't getting to see the fruits of my labor because I had I didn't have any eggs in one basket, much less I didn't have whole eggs in any basket. Like I just had parts of eggs in all the baskets. And I was just like, I'm not getting anywhere. Like, of course I was getting somewhere. I was still, whether I'm getting 5% from them and I own $1,000 or 5% and I own $5, like I'm still getting 5%. But like it was because you're spread so thin, you don't get to actually like notice it takes so much more money to actually notice the thing. So yeah, I think that's the thing is like everybody sees, they identify a stock, and they just, I feel like I want to own it. I don't want to, I want to own my watch list is what they do. Is I guess the best way to put that is owning your watch list.
Absolutely.
So I just thought of that. So if that was good, that was straight off the head right there. So
no, that's like that.
Okay, so 2 more questions for you, then we're done. So this one, because of your presence doing the podcast in the financial industry and being a larger presence on X, I'm sure you hear a lot of myths and misconceptions in the dividend investing space. What are some of those biggest myths and misconceptions, and which one would you like to debunk on today's episode? Like, for example, one that you always hear is dividend investing's for older folks. Like, don't dividend invest till you're 60 and you need the income or whatever. Like, obviously, the earlier you can start with quality stocks and a good foundation, it can actually be more fruitful starting younger than older.
There's a person going around online saying people should not invest in dividend stocks. I want to debunk that. It goes back to what I'm saying earlier, that younger people shouldn't invest in, make it a central part of their portfolio, investing in dividend stocks. Where I think it's wrong is there is a power of dividend payers making a portfolio a bit more efficient and less volatile.
Mm-hmm.
You can go back studies on it, and it's something like a 3% average dividend yield to a portfolio, makes it a little bit less volatile over time. We've been in such a buoyant market lately, people forget some of those maxims, I think. So that's something I want to debunk. Anytime, and I'll just say this a little bit more broadly to catch a net, anytime a person says anything that begins something like never or always run the other way.
Mm-hmm.
I can't think of every qualifier. Never invest in dividend stocks, only invest in dividend stocks.
Mm-hmm.
You in the rest of, that's the stem, the never and the always part. That's the myth I want to debunk. I got into a few months back, boy, the CFP and I couldn't believe what they were saying online. I was like, you're entitled to your opinion, but when you're using the marks of the CFP, which I held, and you're holding yourself out to the public, you just can't shout from the rooftops without knowing the audience. That's against rules of ethics. So I'm rambling on a little bit about this, but he was leading with something. He was a younger CFP. I would judge in his 20s, but it was his personal opinion where he was in his life in investing, where he was saying never invest in dividend stocks. People that invest in dividend stocks are stupid, basically. And That's what I'd want to put out there. The never and the always crowd. Avoid them. They're gonna
Yeah.
kill you.
Yeah, I'm glad you said that because it's like that with everything. Like I'm a competitive level power lifter, and like there's all kinds of stuff where people are like, this is the best whatever. Like this is the best exercise. This is the best diet, and I'm like, it's so independent. It's so
Right.
variable based off of who you are, your risk tolerance, how much money you have, how long of a timeline do you have, like all kinds of stuff like that. And like the time, like if you telling me that you had to, so Kava, the stock you were talking about before, if Kava was at $1,000 a share with the same fundamentals today, you'd probably say, I'm not buying that stock. But because of where it is and what you identified, the fact that there is the room for growth, you identified that as, oh, this is a good stock. But you're not going to say any stock with this, and it's at this price. Like there's so many variables with, I don't know. It's one of those, I agree with you. Like it's always and never and stuff like that. There's so many variables where, not just in investing, but in life in general, where it's, I don't know if you can hear my son knocking on the wall, but,
No,
yeah, so it's one of those things where I completely agree with that. There's no one size fits all for basically anything. I mean, you always need to pay your taxes and never don't pay your taxes. Like that's kind of a thing. But other than that, I don't know. Okay, last question. You ready? So I reworded the question as we were getting ready for this interview, just to try to make it a little bit more fun. So it's still today, but you are again 23 years old, but you didn't lose any of your knowledge. You have all the knowledge that you have today, but you can't be like, oh, well, if I could go back to when I was 23, I would know to buy Apple or Nvidia or whatever. Like none of that. So it's still today, still today's prices, still today's market. You're just 23 years old with today's knowledge. What are your tips for your younger self?
I'm writing something, a parable on this. I call them parables because it's just like an example. And it's this. I'm fast forwarding to kind of answer your question to 20, what year is this? 2024? Let's go to about 20 years, 2044. And the S&P 500 hit 5,000 this week, but I'm projecting 15,000 on the S&P 500 20 years now. Let's just say it triples. We could all relatively agree to that. All right, so the story is going to be something like a kid talking to his dad. Dad, tell me about the time when the S&P 500 hit 5,000. It's 20 years from now. So I'm going to answer your question the same way. Because you can almost back into what you now know. If you knew it then, you could back into that answer. So picture this. It's a story of a kid talking to his dad in 2044, and wow, the S&P 500 just hit 15,000. And the kid saying, Dad, do you remember when the S&P 500 hit 5,000? What were you doing? And the dad said, well, I'm going to dress the story up. The dad still works now, unfortunately, has to work to make ends meet because they never invested. And Troy, you know what? They invested because the market looked expensive. It looked like we have a recession. Could be global world war. It looked like we, name the whole list, presidential elections, all this kind of stuff, the noise of the day. And here it is 20 years from now. And the boy's asking his dad, tell me about when the stock market hit 5,000. You can't get that 20 years back. 20 years is going to happen. So my lesson would be just don't get too caught up in the moment with the noise that's today and let that take you off your game, because you're not investing for today. You're investing for 2044, 20 years from now, when your little boy is sitting on your lap or something. Maybe he's not little anymore. I have to work the story out, but I think you get the message, right? Don't get lost. The message I would say is don't get lost. Just don't get lost today. Just don't get lost in the day, because the future, what you're really building for, is coming.
Yeah. I mean, that's a really good way to think of it. Like another thing that I always think about is like today's all-time highs for like a stock or an index or whatever will be like tomorrow, not literally, but figuratively will be tomorrow's 52-week low, or that'll be the crash point. So like it'll be one of those things where like, on at the time of recording this, on Friday the S&P 500 hit 5,000. Literally 3, 4, 5 years from now, we'll go through a market correction and the market will go down from 6,000 down to 5,000 and everybody will be losing their mind. But like, to your point, people are saying,
Right.
"Oh, don't invest or whatever," because the market's overvalued or whatever. Like, eventually, that'll be the correction, is where it is today.
Yep.
Yeah,
Exactly. Sorry, I had to hop off video. I had to just move around for a second to continue the conversation.
yeah. No, you're okay. You're okay.
But yeah, that's so right, Troy. It's like I agree. The market, I mean, on a historic basis, it's expensive right now. I mean, it is. Empirically, that's the case. That doesn't mean it's not going to stay high. That doesn't mean if you've got a long time horizon, you should be out of it, in my opinion, unless you know.
Yeah, yeah.
Unless you know.
I mean, the more I think of it, like whatever stock A goes out there and they hit $100 as their 52-week high, eventually they'll be on the same list for a 52-week low of $100, and everybody's losing their mind. Is this stock going to go to zero? Whatever. But like, however many years prior, that was literally the highest the stock's ever been. So some people are like, "Oh, don't buy it." Like that's one of the things I mentioned in my Power 5 series is the highest percentage off of the 52-week high, and the idea behind that is, hey, this stock showed support at the level that it was. Whether it's 20, 30% higher than it is today, it clearly was there and was able to sustain that and climb to that amount. So by me showing you the stock that's 23% off of its 52-week high, as long as you still see the same values that got it to that point, there's upside of however much it's down, because it'll eventually, in theory, go back to its 52-week high and then some. So like that's kind of one of the reasons I picked that category. So yeah, that's a really good thing that you're talking about, because yeah, so many people are just, I mean, fear sells. I mean, that from being on the interwebs, and I'm on YouTube, and like how many times you see a thumbnail with fire in the background or somebody's hand in their head or head in their hand or all kinds of stuff like that. And it's just, it's way easier to scare somebody into not doing something or scare them into doing something than it is to convince them like, hey, your future, you would thank you for today's decisions if you do it right.
Absolutely.
Yeah, I agree with that. I'm glad you said that. So anyway, Tom, it's been a pleasure speaking with you today. I hope I told you these things are hard to keep to an hour. You get to talking about all kinds of fun stuff. So it's been a pleasure. I want to thank you for taking time out of your day and pushing your roofer back to speak with us. I hope everybody watching got to enjoy all the things that I said and Tom said. Make sure you guys remember to leave a like on the video. And Tom, go ahead and tell the people where they can find you. I know you're on X. I know you have that podcast, so go ahead and tell them about it.
Yeah, absolutely. Very active on X under the handle at Savings Captain. And then I run a podcast on all podcast directories called Money Happy Hour, 2 episodes a week. Every Monday, an episode with an everyday investor telling their investing journey. And then on Wednesday, I try to put out an episode that is, I call it, more current events, kind of like giving my thoughts on the mood of the day,
Mm-hmm.
what I'm seeing out there in the markets, and just using some of my past experience and just giving some perspective. I'll take the headline and go a little bit deeper than the actual headline, just try to get into the story. So that's what I do. It's Money Happy Hour on all podcast directories.
Yeah, definitely go check that out. So if anybody wants that, Tom's going to send me the links to all that stuff. I'm going to put it down in the description. So make sure you guys give Tom a follow on Twitter if you're not already following him, or X. And then also go check out the Money Happy Hour as well, because you can get a lot of good information in there. It sounds like Tom does the interviews like this, as well as probably unpacking what the headline of some news is and breaking it down to not scare you as much as they try to. So very valuable content. And again, Tom, thank you so much for taking time to speak with me, and we'll talk to you next time. And that's going to wrap up this week's discussion. I really hope you enjoyed my conversation with today's guest, and thank you for spending part of your day with us. Remember, if you want to be on your very own episode of Dividend Discussion, make sure you reach out via email at dividendobsession@gmail.com, and I'll be in touch. But until next time, see you.